Job openings rose more than expected in April as tariff hikes took effect. The hiring rate also rising as the report sets the stage for the all-important May jobs report. RSM Chief Economist Joe Brusuelas is joining us now to discuss. Joe, it's great to see you. We keep sort of waiting, right, for the effects of the tariffs, the effects of the concerns around the tariffs to show up in the data. And we keep not really seeing it. Or are there signs here that we're sort of missing?
You're only seeing the preliminary signs. They're buried deep in the hard data. It was always going to be the case that you're going to get a lag once you hike import prices before it really shows up in a more systematic way. We were always making the case that it was going to be June, July, and August, which means the reporting time is July, August, and September. We're going to publish something tomorrow where we're looking at the sharp decline in shipments inbound into Los Angeles and Long Beach. And we think that you're going to really begin to see a lack of material on the shelves during the first 2 weeks of July. And then you'll get not only employment, but you'll get, more importantly, pricing data that then will reflect that. We'll have a much different conversation going forward. You know, unfortunately, we're just sort of in the interstitial between the time the policy is put in effect and the time in which it shows up on the shelves and in the data.
When do you think, Joe, it shows up in the labor market data with the big jobs report coming on Friday?
The labor market data is lagging under conditions like this. So I wasn't expecting that until later in the summer. But we already had a cooling in terms of overall labor demand, and I'm expecting a net gain of 125,000 and an upward migration in the unemployment rate to 4.3%. Wages should increase about 0.3%, which will translate to 3.6 on a year ago basis. But I do think we're going to want to watch hours worked. That going very closely, because that may be the bellwether in terms of, you know, if hours worked stagnate or decline, your business expansion is not going to continue in the same way. Moreover, for me, the big number is 100,000. We need to see an increase above 100,000 to keep employment conditions stable. Should we see not just the top line, but the top line plus whatever downward adjustments made for the past couple months, and I think that there will be a modest one, does that arrive above 100,000? If it's below, market's likely to respond because, hey guys, let's face it, right now the market's trading on sentiment. There's not a lot of fundamental action out there, given the uncertainty over the direction of trade and the knowledge that we're going to have some tough data over the next couple months. So right now we're just moving from day to day. Not very satisfying. I'm not really enjoying the explanations I'm hearing. They tend to be really ad hoc, right? But we're stuck in the middle right now. We're just going to have to wait this one out.
And so long story short, Friday is not going to be the sort of make or break report because we're not yet going to see. So what number are you looking for then? It sounds like you think we're going to be remaining pretty comfortably above 100,000 for now.
Yeah, that's right. You know, I'm an economist, right? So anything above 100,000, I'm like going to nod my head, yeah, that's pretty good, right? Maybe nothing to write home about, but as long as we're there, employment conditions remain stable. That means wages are stable, and the economy is going to hang in there, even though it's, from my point of view, it's cooling, right? And then we'll see where we get when the more visible or tangible evidence of the price shock shows up. But we're just not quite there yet.
Given your outlook, Joe, what are your expectations for the Fed? What's the Fed's smart move here? Stand pat, cut? What do you think?
The Fed absolutely has to stand pat. Well, I know they want to cut. I know the market wants a cut, but it would be imprudent to do that. Cutting rates into a situation where you're going to get an increase in prices just is not the proper policy response here. They need to wait to ascertain how broad the damage is, whether inflation expectations remain anchored or they really come undone with a second price shock in less than 5 years before they can even take a step forward. I mean, we provisionally have 2 rate cuts of 25 basis points each, one in September, another in December on the board. But I got to tell you, Josh, it's looking to me like if we get one this year, we'll be lucky. And that may be just at end of the year, a holiday gift. That's if the Fed decides it can look through the price shock because they think that it's only going to be, this duration is limited. I'm not going to use the words you want me to use because I'm not going to go there. I don't think the Fed should go there with the T word. But we'll see what happens later on this summer into the fall.
I'll say it for people who are watching. He's talking about transitory, folks, but I can say it. Joe doesn't want to say it. Joe, finally, I want to ask you, going back to jobs for a moment, for two other elements that we have been waiting for in terms of their impact on the job market. One, the federal government's job cuts, which, as we know, are sort of all over the place, off again, on again. Some of them, we don't know what the outcome is. And then secondly, the effect of the crackdown on immigrants in this country. I'm just wondering, is that yet percolating through the data?
So on the first part of the question on the job cuts in the federal government, it's T+6. Take whatever that happened and wait 6 months, and then it will show up. So the original cuts made by DOGE, you can expect those to show up in September, October. The other ones that we're seeing, Department of Education, other areas, that'll be a little bit later in the year. Okay, the immigration question is really interesting because they don't have the budget to hit the target, which is 3,000 deportations a day. Once the budget's passed and then immigration's fully funded, then we'll see that step up. Now that's going to get interesting because right now we get the increase in prices from tariffs. Labor's not in a position to bid up wages, so you're not really running the risk of a wage price spiral. But once they step up deportations and labor gets very tight again, even though the economy's slowing, we get some real interesting interaction effects. Chris Waller was out there talking about it this week. I know he's running to be the head of the Federal Reserve after Jerome Powell leaves, but he specifically left off the very important effects that tightening immigration via the policy channel and deportations could have a real pervasive or perverse effect on overall inflation later this year into early next year, because we don't really have a good experience when trade and immigration policy intersect and provide adverse impacts on both the labor market and the overall economy. So the Fed really needs to move cautiously here.
Joe, always great to see you on the show. Thank you, sir.
Hey, Josh, thanks to you. Good afternoon, guys. Always good to talk to you.